Thanks a lot, Tracy, and thanks to your hardworking team as well. The first event with Spencer was fantastic, and the crew behind the scenes is doing a wonderful job of keeping the show moving. Kevin Schmolt with Newmark Knight Frank, welcome back. I'm the managing director here in the Milwaukee office, focusing on retail. I handle retail investment sales in addition to some leasing. And when it comes to retail investment sales, my specialty or my niche is neighborhood shopping centers, both anchored and unanchored. So as part of organizing this panel here today, I invited some of my peers to join me to talk about their perspectives and other asset classes as well. And with no further ado, I will introduce or welcome Christian.
I'm Christian Tremblay. I'm a net lease investment sales broker at Mid-America Real Estate in Chicago. Our team represents both sellers and buyers on the acquisition of single tenant to 3-tenant retail properties throughout the country. These deals range anywhere from a $500,000 Sherwin-Williams property to $35 million grocery stores.
Thanks, Christian, and welcome to Jeff, joining us from, I believe, Florida today. Looks like maybe you're in a coffee shop, Jeff.
I am, so hopefully not much background noise here, but thanks for having me, and having a little internet issues in another location, so I had to relocate. So
it's the year of COVID, work from home, work from the third space, right?
That is exactly how it's been since March, so I appreciate you guys having me. And so my name is Jeff Roulette. I'm a senior director with our national retail group and also the net lease properties group of Marcus and Millichap. So our firm specializes exclusively in investment sales. So we focus on helping our investor clients buy and sell and also refinance investment properties, primarily retail, but I also have a couple guys that do industrial on the team. And most of our transactions are with private investors. We do some institutional work as well, but for the most part, we're in the $20 million and under space and do a tremendous amount of single tenant net lease transactions as well as multi-tenant. So.
Well, that's great. I'm looking forward to the discussion today. I think we have kind of a unique perspective on what's happening in retail and commercial real estate investing. And I guess let's just jump right into it. We're sitting here. We're finally in September. It's been a fast year and a weird year. Jeff, you and I were in conversation before, just moments ago, before this presentation, talking about what March felt like for each of us. I thought you had a unique perspective on your speed, and you were in fifth year back in March.
Yeah, actually, it looked like 2020 was going to be a record year, and going into the first quarter, there was a tremendous amount of velocity in the marketplace. We had some 1031 deals that were rolling over, and I was down in Mexico actually celebrating our National Achievement Awards, and came back, I think it was March 6th, and then there goes the grinder, so sorry about the background noise. But we got back March 6th, and I think it was around March 15th is when obviously everything started to be announced that there was going to be some shutdowns, and retail in particular was going to be impacted by that, and it was getting very interesting very quickly. So at that point, I had a number of single tenant transactions under contract, but also had 11 shopping centers under contract. And over the course of about 4 to 5 weeks in there, one by one, they started falling like dominoes, and all 11 of those multi-tenant contracts ended up terminating for one reason or another, COVID related for the most part. And then we've actually picked up a couple of those, but it was a very, very tough March and April and into May. So
how about for you, Christian? Kind of the same story back to March?
Yeah, I mean, kind of what Jeff hit on. I mean, I think in March there was just kind of an initial shock to the system where, we had a number of deals that went on hold. It seemed like the market in general went on hold, and deals fell apart. The extension to the 1031 deadline to 7/15 also gave buyers kind of more time to think about, hey, should I be moving forward on this deal? I had now more time to identify my property. So I think that they, became a lot more selective. But exactly as Jeff said, we had a number of deals that were under contract, and some of them kind of contingent on getting lease extensions throughout due diligence, and tenants also went on hold, and a lot of those just fell apart because of it.
So let's talk about a data point, because I think we'll start here and we'll kind of end here as well. if we take ourselves back to January, February, March, first quarter of the year, in thinking about our listings, in taking a well-priced, well-positioned, good asset to market. I mean, I can speak for myself in saying that I closed as a broker. I closed on the sale of a portfolio of shopping centers, 4 unanchored neighborhood shopping centers in Milwaukee, about a $15 million volume. It went under contract in the fourth quarter. Due diligence extended into the first quarter. But to use that as an example for my specialty for neighborhood shopping centers, for that portfolio, we saw 11 offers in earnest, sort of 20 indicative prices, 11 offers in earnest, carried 3 or 4 buyers into the final round, and obviously made our selection. What was your experience like in the first quarter for assets? And I'll ask because I want to come back to this towards the end of the presentation now that I think we're all open for business and being transactional again. And I want to compare this later in the discussion to what we're seeing for assets that we're launching today. But what would you have expected in terms of signed CAs or submitted offers on property looking back to the first quarter?
Yeah, I mean, even from the fourth quarter of last year, I felt like our volume was picking up a lot. We were doing a lot of deals at the end of the year, and those were kind of pushing into the first quarter of this year. As Jeff said, I thought it was going to be a record year for us. But more CAs, more offers, just, general good sentiment of what was going to go on for the rest of the year. And then, as soon as March hit, the first 2 weeks, same type of thing. It looked great. And then, I think it was March 21st or 19th, something like that, when everything kind of just went on hold. But yeah, I mean, I think we were getting more CAs and more offers than, kind of ever.
Yeah, same here. It was what was interesting was a lot of the single tenant deals still continued to move forward, and we started seeing a big increase actually in our industrial assets that we had on the market. So that got really spicy there for a while, but it was really the multi-tenant, and a lot of it had to do with the fact that financing at that point just kind of hit the pause button. A lot of lenders were pulling back, and they didn't really, to no fault of their own, it was very difficult to figure out how to underwrite these deals when 30, 40, 50% of your rent roll has closed their doors and is no longer generating revenue. It's like, well, how long is this going to last, and how many of these retailers are going to survive and how many of them aren't? So it was really an issue of not being able to underwrite them, and that's why we saw a lot of our contracts start to, we had requests, where it was saying, let's extend out due diligence 3-4 months, and obviously that didn't make a whole lot of sense. So it was, at the end of the day, sellers said, let's just terminate, let's let things settle down, and then we'll figure out where to go from there. And so luckily some of those contracts have come back around. We put some of them back under contract, and deals are moving forward now that we have a little bit more of a clear picture as to what's going to.
So Jeff, given how long have you been in the business? How long have you been selling investment properties?
18 years now, a little over 18 years.
And the last peak was probably what, 07, 08?
Yeah, for sure. Yeah, 06, 07 was a big run up, and then up until March, again, it was kind of it had a very similar feel to it, but it wasn't.
Yeah. So how would you compare it? Like, if we call it the peak, maybe February or March, how would you compare February, March 2020 to a previous peak you've experienced in your career?
It seems like there was from 20, I think it was end of third quarter, beginning of fourth quarter 2016. If you look at the stats and you look at Real Capital Analytics and CoStar and all of the different tracking metrics, it was like fourth quarter of 2016 was when we kind of hit the top. And then that was the time when everyone said, sooner or later we're going to have a slowdown. Everyone kind of started predicting that interest rates were going to go up and the market was going to cool off. And then we saw a little bit of a plateau, but then it just carried through 17, 18, 19. We just kept going. And so that it was an interesting time, but it's felt like everybody now started to realize that the market had some legs and there was a lot of runway left, and we were going to continue to transact. And it was very different from the crash of 08, obviously. And COVID is such a black swan type of scenario that nobody expected that. It's a much different situation now because all the fundamentals of the market were still strong going into this. Right. So I think that's why the stock market has done what it's done, and I think it's why we've continued to see investors show activity and transaction volume has picked up. relatively quickly. I think second quarter, the stats are pretty much tabulated at this point that we were down about 60% in terms of transaction velocity. But I'm feeling personally right now like the fourth quarter is going to be extremely active. We're seeing it just in terms of, incoming calls, inbound LOIs and contracts and things like that. So it seems like everybody's ready. We've been locked down for too long, and everybody's ready to get back to it. So
let's talk briefly about, so we talked about what's happening before COVID in our markets and what we were experiencing for demand. I'll speak for myself first, because in addition to investment sales, I handle leasing as well. I represent landlords and I represent tenants, probably heavier on the landlord side, but I'm in that world too. So I'll speak for myself, and I want to hear from you guys what you did in those pause months when that transactional volume fell off a cliff and buyers and sellers were holding their breath to see what happened. I mean, what I was doing is I was involved with my landlord clients on a daily basis, and many of my tenant clients as well, helping them to navigate rent deferrals, the path forward. We did a lot of renewals during the period. We did some things that I think are really going to help the three of us here on this call, sell properties in the future, in that we were able to install clauses in leases for sales reporting, and we were able to get some things that will really be instrumental, in my opinion, for the future of these investment sales. Every buyer, of course, wants to know now how that tenant weathered COVID, how that tenant behaved. Did they communicate, or did they hide themselves in the closet? Did they renew and show optimism for the future? How did they change their business model to adapt, et cetera? But there's about a 3-month period in my year where I wasn't transactional either on my leasing side of the business or my investment sales side of the business, but I found myself as sort of an advisor or counselor to both landlords and tenants. So what did you both, I think, focus strictly on investment sales. So what did those 3 months look like for you?
I would kind of agree. I mean, I think a lot of the things that we did was a lot of sharing information on talking with other brokers and buyers and sellers, and sharing a sentiment of, hey, this is what we're seeing, what are you guys seeing? And making sure we're all in the same boat and kind of all here for each other. I think it kind of opened our eyes too, and representing buyers is, you kind of have to go into some deals with a little higher level of scrutiny. I think even now we're seeing buyers kind of pass on deals where there's a little bit more hair. There's a lot of good deals out there. So I think it definitely changed the landscape as well. And I think sales reporting is a great point. I mean, transparency of financials and unit level or entity level is just huge. And it was kind of weird. I mean, before this, we were seeing, franchisee deals trade similar to some corporate deals. And, that's a little bit surprising to me when, yes, you can see unit level financials for franchisees. But I mean, you're getting a corporate entity with an Arby's or a KFC or something like that. So yeah, I think it was a tough 3 months, definitely less deals going on. But it was good. I mean, I think it was a lot of reaching out to your existing clients and keeping those relationships and kind of letting them know you're there for them once things kind of turn back around.
Yeah, similar here for us. I mean, it was just communication. We spent a tremendous amount of time. It was like death by 1,000 cuts. It was death by 1,000 conference calls and webinars at that time. But I mean, we were having like 3 or 4 calls a week with our capital markets groups, and we were keeping track of, who's in the market, who's not in the market in terms of regional and local banks, the life insurance companies, the conduit lenders, and trying to figure out what they were lending on, what they weren't lending on, how did we get a deal done if we had a deal already under contract, trying to make sure it got to the finish line. So there was a lot of that, just working on the transactions that were already under contract, and then there was a lot of research and a lot of just kind of fact finding, and then translating that to clients. So we were spending probably, more time than I have ever had in my career on the phone with clients, helping them work through issues and helping them to navigate through the rent abatement and rent deferment discussions that they were having with their tenants. So we weren't selling, we weren't calling during that time, starting new transactions. I mean, a lot of it was helping clients to navigate through a tough time in the market and help share information and just be there as much as we possibly could if they needed to try and figure out a way to refinance a property and then from there things started to pick up a little bit. But it wasn't the time to start making cold calls and knocking on doors saying, hey, you want to sell? It's like we got other issues that
right.
bigger issues at hand to deal with. So I found that a lot of our clients were anxious to figure out what was going on and what other owners were doing. How were you, what's your experience been? Do you have the same tenant? Are they paying? Are they not paying? I mean, I think one of the big surprises was the amount of larger, we'll call them credit tenant type tenants that really shouldn't have had any issue paying rent, and all of a sudden they got a letter from them saying, hey, we're not gonna send a rent check for the next 3 or 4 months. And some of our private investors who aren't accustomed to having to deal with those types of issues were scrambling, trying to figure out what to do. So we spent a lot of time helping them figure out how to respond to that and what steps to take.
That's a good point, Jeff. One thing that I think is interesting, given my optics for having a portfolio of lease listings as well, and being on those calls with those landlords, was the behavior of some of the national tenants compared to the local tenants. And I wouldn't have predicted it. Looking back on it now, it's the picture is much more clear. I would have predicted that national tenants with deeper pockets and access to institutional lines of credit, et cetera, would have kept paying their rent, and you wouldn't have heard from them. And that the local tenants who are working to feed their families and don't have a lot of depth on their balance sheet would have been the ones really asking for forgiveness and asking for flexibility. But my experience was pretty well the opposite. And having now time to reflect on why that was, I think that these national tenants sometimes view themselves as being a commodity and being very valuable to a landlord, and they throw their credit around, their credit rating around, and know that they have leverage in that discussion. Whereas a local tenant, especially a franchise tenant or a local, just a local business, I think there was a lot of fear from those tenants for losing their livelihood, and they know that much like not paying your mortgage, you'll go into foreclosure. You don't pay your rent, you lose control of your space. And that was one thing that I thought was super interesting through this process, and I think it's going to drive an increased attention from investors to neighborhood shopping centers and to non-credit tenants, just because they were some of the better actors through this through this entire pandemic.
Yeah, and that's one of the things too that I heard a lot of clients say. If the communication is open and we're talking about it, and you truly let me know what's going on, we can stay ahead of this and work with you. I think for others, it was a little bit of a blind side that they didn't see coming, so it was harder to kind of navigate through that. And then also the impact of that was, some of these tenants that, some of the larger national tenants, if the owner of the property was getting some flexibility and getting some reciprocity from their lender, then they could pass that along to their tenants. But if that major tenant stops paying and now they can't make the mortgage payments, now they can't help out the smaller tenants. So there was a lot of complexities that were going on that we were helping tenants kind of navigate through. So I'm sure you guys were dealing with that as well.
So it's kind of a transition into where we are now. I think we've all started to list properties and find success, find some momentum, and let's get to that. But is part of what I'm seeing now with some of the shopping trying to sell is an increased focus by investors on their basis, not so much looking at what this credit tenant who might be part of this multi-tenant shopping center is scheduled to pay, but what's it really worth? What's it worth if they go bankrupt? What's it worth if they don't escape COVID? What is it worth? We've all seen the shopping centers that were built in our market here in Wisconsin. You get into the 30s and 40s on a net basis, you're in that upper echelon for rents. And those shopping centers were trading really without much pause and with a lot of competition, with basis, $400 per square foot and greater, $500 per square foot in some cases. So now the conversations I'm having, I'm curious to find out if you're having the same, are from investors who are really trying to buy a property at the right basis so that if they have that vacancy, they can schedule a realistic period of vacancy and a replacement rent, and not relying so specifically on the underlying credit.
Yeah, I think Jeff can answer it a little bit better than I could, only because the deals that we focus on are typically newer construction, and a lot of them are credit tenants. So I'm not dealing with it as much as Jeff might have to. But I think, we've always been big proponents of focusing on real estate, right? I mean, I think a lot of buyers are buying credit and term, and that's kind of been the net lease space forever. But I think now it's going to say, a lot of people are going to look harder at the real estate and making sure that, if these guys ever left, especially in a single tenant building, what is this land worth? If I'm buying, a $8 million Walgreens and Walgreens for some reason disappears, is this land, is it ever going to be replaceable? And, a lot of the times it's no.
Yeah, the $8 million Walgreens deal gets backfilled with, a dollar store or something. It's a completely different scenario than, Christian, to your point, I think whenever we have disruptions like this in the marketplace, it makes everybody take a step back and go back to the fundamentals again, because when we're in a hot market for a long period of time, things get a little bit more relaxed, and people maybe all the way from buyers, lenders, et cetera, they start to maybe relax in terms of the due diligence and the scrutiny of the assets, and we start cutting corners a little bit, and then when something like this happens, everybody gets back to the fundamentals of location and are the rents replaceable, and what is the space configured correctly, where you're going to be able to have a large pool of tenants that are going to be interested in it, or is the space more challenging, and what is it, lighted intersection, high visibility, et cetera, et cetera. So we kind of it's one of those situations where everybody's going to kind of hit the reset a little bit and get back to the fundamentals again, and make sure that they're buying assets correctly on the front end, and that the property is well positioned for long-term and future growth. And those are all great things that we should be doing all the time. So I think a lot of it kind of weeds out some of the challenges and some of the just the lax nature of maybe the cavalier attitude that we get into when things are just cranking along, and we all get a little too comfortable, I think, at times. So this is a good time for everyone to go back and take a look at their portfolios, analyze which assets they're holding in their portfolio that is going to be a good core asset long term, and those that they're going to need to maybe trim off. So it's I think that's what we're going to see going into first and second quarter of next year.
Christian, talk to me about categories. Talk to me, in your single net lease world, what were some of the categories that were most attractive pre-COVID, and what are you seeing today in terms of demand for post-COVID categories?
I think a lot of the ones are still, that were previously attractive, are still attractive. I think that there's just a bigger sense to buy these essential businesses, right? The pharmacies. There's been always a high demand for grocery stores, but I think even more so now. Dollar stores, C-stores, QSRs with drive-throughs so that they can still operate, and now more focus on high investment grade tenants. One that I think kind of came around was, I think for the last 24 months prior to COVID, pharmacy sale or cap rates have been going up. Since I would say April, we've definitely seen a high demand for pharmacies. People were a little worried about downsizing their locations, as I mentioned, higher rents and really trying to right size those rents, which they did at a lot of locations. But strong performing Walgreens sales. I mean, we have one in the market in the North Shore of Chicago, and we're getting a lot of traction on it. A lot of strong buyers that are both institutional level as well as 1031 exchanges. So I think that the demand, and kind of more even so competition for these types of deals has increased. Seeing a lot more off-market deals where these guys are paying just premium pricing to be awarded off-market opportunities, and I think that's going to continue. So it's been definitely a good last few month or two, and I really think it's going to continue into this next quarter and the beginning of next year.
And how about for you, Jeff? What are you seeing out there in terms of some of the more attractive asset categories garnering the most attention?
Yeah, COVID has kind of split the market into the essential versus the non-essential, or the discretionary versus non-discretionary. So I think we're seeing that. What's interesting to me is before so we'll coin it BC, before COVID. It was restaurants, entertainment, and fitness. Those were some of the most robust categories in retail. We were seeing a tremendous amount of leasing activity and investment sales in those areas. And obviously those are some of the ones that got hit the hardest because they had to be shut down just due to health concerns, gyms, for instance, and theaters and restaurants, et cetera. So, then we've kind of shifted into grocery, dollar stores, pharmacy, things like that have been deemed essential, that have actually, I don't know if it's fair to say benefited from the pandemic, but they've had sales increase due to the pandemic. So I think that's the trend that we're going to see long term. And now it's a lot of the discussions that we're having with clients is figuring out what's next. What is going to be the next wave, the next trend, and trying to stay ahead of that and figure out how things are going to look post-pandemic, and making sure that you're merchandising your centers accordingly. And that, we used to just kind of look at everything through the lens of what's internet proof. Now we have, we got to make sure it's internet proof and pandemic proof, I guess. But that's what I see, as a trend moving forward. So right now, the stuff that we're seeing more activity on, and I'm leaving industrial out of this, and maybe I shouldn't, but obviously, I had more what I would consider just pure retail buyers historically. Let's say for the last 10 years, I've worked with a client and all they've essentially purchased was retail. I had more conversations over the last 6 months with clients that are now saying, hey, I want to buy industrial, or I want to, maybe diversify my portfolio. So, that's another area, obviously, as well as some of those other categories within retail. But,
that's interesting. Yeah.
Yeah.
Well, I think there's a distinction. You made a good point there. You're talking about buyers who play in various asset classes and that movement from one to another. And I think one thing that I've taken away from this is in just identifying and trying to really analyze the types of buyers that I'm hearing from for the neighborhood shopping centers. I'm seeing a surprising number of investors who have good portfolios, both privately held in funds, who are interested in buying more retail, and that's a good sign to me, in that they're comfortable with how their current portfolio is performing. They're obviously happy with their current collections. They feel comfortable with the asset class, and I think it's one of those things too where you're not going to read about it on the front page. Obviously there's challenges in retail, and I think in large part you're going to see that with the regional malls. But for these local shopping centers, I think if you were to ask in private some of your clients about their own collection rates and their own patterns through this event, they're doing quite well. And I think there's a number of buyers who are interested in buying more retail because they assume there won't be as much competition, there won't be as many buyers for what I sell, maybe not for what you sell, Christian, but for these neighborhood shopping centers, there's perception that there'll be less competition, they'll get a better cap rate. Debt is still incredibly affordable, especially for the that I spend most of my time in, dealing with shopping centers. We're dealing with a lot of banks, we're dealing with a lot of credit unions. We're getting rate quotes in the threes, 25-year AMs, 7 and 10-year terms. So the yield on some of these investments are great, but we're seeing a lot of encouraging signs from the industry as portfolio holders of retail real estate are looking to buy more. And then a surprising trend that I've seen is a few buyers who have come out of multifamily. These are local buyers, local here to Milwaukee or southeastern Wisconsin, who have multifamily, aren't sellers for their multifamily, but are trying to jump into the retail game. And I was able to pull sort of a few of them away and ask the question why, and it's for the same reasons. And they're finding surprise, which is good for our sellers. They perceive that there are going to be better deals, that they're going to be able to buy properties at higher cap rates with greater returns. But what they're finding once they enter into the market and start asking questions from brokers, et cetera, is that the competition's still there. We had a shopping center in the North Shore here of Milwaukee, a little $2 million deal that we took to market. It was the first asset that we really broadcast wide after COVID. So it was a hold your breath moment for me as a broker and for our client as well. But we saw 6 offers. We saw 3 offers within 2 days. And these were legitimate offers from legitimate buyers who asked good qualifying questions and had rate quotes from their lenders who are eager to put money out the door. So, I think some of the people who are trying to come into retail looking for the deal, I think are surprised right now that those deals aren't there and that the cap rates really haven't changed. I mean, for my neighborhood shopping centers, we're talking about 50 basis points, 25 basis points, or maybe even the opposite. We're finding very little movement in the valuation for these neighborhood shopping centers. I'm curious if how that pertains. I mean, what's been the difference in pricing pre-COVID compared to now for assets that you two have on the market?
Honestly, I would say some of the stuff we're seeing is even more aggressive than it was, which is a little surprising. I mean, we're seeing some McDonald's trade at crazy cap rates in the mid threes, and Chick-fil-A's that had always been trading low fours to 4.5. I mean, they're trading at like fours now, and the people are really stepping up. I think is one of the big things is willingness to pay up for what they're perceiving as more perfect deals that they think are very resistant to a pandemic or internet proof stuff, exactly what we were just talking about before. But we're also seeing not only competitions from private buyers and exchange buyers, but I think a lot of these funds now are coming in and paying aggressive cap rates that are kind of competing with the 1031 buyers, where 1031 buyers were pretty much beating out a fund on most deals, but now we're seeing even more competition from them, which is a good thing for us. But in terms of pricing expectations, I think we are getting a lot more offers on our deals, but we're also getting a lot more offers from buyers coming in at a cap rate that's 50 basis points above our asking, and they're like, well, it's the pandemic and these sort of things are happening, but there's really no data that we're seeing that cap rates are really going up 50 basis points. We're seeing things trade pretty much the same. So we can't really say, yeah, you're right, this is this Panera is worth a 5 cap when it's really worth like a 4.5. So it's been interesting in that regard. And I also think that there's a willingness for sellers just to wait it out for some of these buyers, especially the 1031 buyers, to get premium pricing.
Perfect point there, Christian, because we're seeing, so you're dealing obviously with a lot more single tenant assets and credit tenants to boot. So with the multi-tenant, what we've seen is, there's, like I said, there was a pause. There was kind of a wait and see attitude there for a while, and then we were tracking all the tenants and figuring out exactly, not even just who got, who was awarded rent abatements or rent deferment, but even if they asked for it. So we were keeping very detailed notes on each one of the tenants and what collections were. And the sellers, for the most part, they haven't had an issue making their loan payments, and we haven't seen a lot of quote unquote distressed assets hitting the market. Obviously, I think part of it was we were all waiting to see how long is this going to last. Every month that goes by where there was issues where tenants weren't able to reopen, that would have caused more and more stress and pressure on the system. But now that everybody's back reopened, and I guess we could certainly throw in the big question is this fall and this winter a resurgence or a second wave or whatever. But barring that, most of the tenants have gotten back to business for the most part, and they're generating revenue. They're paying their rents, the rental abatements and deferments, and if they got assistance from PPP loans and things like that, we didn't see a lot of that distress actually flush through the system and create opportunities where there was, big discounted acquisitions occurring. So I think it was a lot of it had to just do with the time frame, and the longer this goes on, obviously the more stress and pressure it would have created. But it seems like we've worked through a good chunk of it, and I don't know what your guys' thoughts are, but it certainly seems like we've gotten through the trough and we're clawing our way back, and things are starting to stabilize again. And I personally don't think we're going to see a lot of that distressed or auction type properties hitting the market. It seems like most of our clients, thankfully, have been able to weather the storm and get back on track. So hopefully that continues.
Yeah, we're not seeing any signs of any distressed assets coming back. And usually we'd be the first to know as it relates to leasing as well. Usually we see a leasing assignment and there's always a question for what that's going to do to someone's, debt service coverage, or if they have a near-term expiration on a loan. But we're not expecting anything substantial in terms of a wave of foreclosed properties. I think there is an interesting distinction. We've been talking about buyers and sellers and types and the way different groups weathered COVID, and I think there is a distinction between people who invest in commercial real estate and people who operate commercial real estate. And I saw, and it sounds like the three of us all had some of the similar conversations. There's some people who were built for this and knew how to respond to their tenants, and then there's some people who were just blindsided and needed a lot of coaching. I think those people who needed coaching are probably the people who are looking to get away from the asset class, looking maybe for a single tenant net lease investment where it's a set it and forget it investment, not dealing with 3, 4, 5, 6 tenants, making some of those daily decisions. But I think you both made some interesting points there. At its core, what we really need is a buyer, a seller, and a bank, unless it's a cash buyer. Who are you guys hearing from right now in terms of debt?
I'll jump in real quick. Yeah, I mean, we're, in the beginning there, like I said, we were doing 3 or 4 capital markets calls a week. So it was changing. I mean, I remember the first couple of weeks, it seemed like hourly. It was changing like who's in, who's out. And, CMBS seemed to take the biggest pause out of all of the categories. But all along, we've really seen local and regional banks stay in the game. Now, there was some fluctuations. There was some changes in some term sheets that, where we had a deal on the table and it got pulled off the table and kind of revamped. And then they came back and said, well, we're still willing to do the deal, but we need the buyer to, we're either going to lower the leverage or we're going to require more reserves up front. So, I mean, it ended up kind of being 6 of one, half dozen of the other. I mean, whether you're asking for more equity up front or just having them fund a reserve account, the reality is the leverage position was lower. But so we saw some maneuvering there. But local and regional banks have stayed in the game from what we've seen pretty much throughout. Life insurance companies, they were being more selective. So there were certain deals that probably weren't passing their underwriting standards. So those deals fell apart. But the other ones that still had, strong credit, had good collections, and we were able to be transparent about the tenants who were paying and didn't have any issues. Those deals stayed together. So. And now when I talk to my capital market sources, they're even saying that, the CMBS debt is back in the game. So, like anything, it's always deal specific. So every single situation is different. Every location is different. Every rent roll is different. And, it depended on how many credit tenants. If you had I've got some grocery anchored centers where obviously the grocers are doing great, but then the small shop space in the center, 30-40% of those tenants were closed and for a couple of months. So those deals were harder to figure out and underwrite. And then as they reopened, then we kind of reset those, and now they're back and under contract, and there's plenty of financing available for that. So it's one of the things that it's a little bit frustrating, and I'm sure you guys and our clients probably feel it as well. But if you watch the headlines and watch the news, there was a kind of a big, broad blanket thrown over retail and hotels as it's just a nightmare and it's, the sky is falling and it's terrible. But it really wasn't like that. There was actually subsectors of retail that were doing phenomenally well because of the pandemic, like we talked about, the pharmacies, the drugstores, the dollar stores, grocery, and so you can't categorize everything together. Every deal has to be looked at individually.
Yep.
Well, in your subset too there, you mentioned medical and you mentioned, we talked about regional malls earlier in the discussion. What we're seeing on the leasing side, which eventually is going to translate into what we're seeing on the investment sales, are people leaving the regional malls just before it's uncertainty, or we're seeing a lot of professional occupiers or medical tenants who may be part of a larger medical office building who don't want to be vulnerable again to that shared space environment, common areas, et cetera. So we're seeing a huge influx of interest right now on the leasing side and eventually the sales side for shopping centers where the dentist or the physical therapist or the professional service provider wants direct access from a parking lot. And retail, the delta, the cost for retail because of some of the transitions our industry is going through, it has come down in some respects. And so these occupiers are coming out of these other environments and creating demand. We've had situations where we've taken back a COVID vacancy, vacancy as a result of COVID, and had tenants compete for the same space, and they're already leased with new businesses operating who opened during COVID. And these are things that I think are relevant to this conversation, as it gives that same pool of investors who I was describing as already owning retail, it gives those investors more confidence to buy more and to continue to be signing those CAs and requesting those OMs.
I think everybody is going to look back and say, should have bought as many assets as I possibly could where I could lock in 3% each. So,
Yeah,
but
exactly.
also, Kevin, I don't know, you're probably going to see it more on the front lines than Christian and I, but what about the trends that we're hearing about going from urban to suburban markets again? And the suburban office, I mean, there's a lot of talk about that space getting absorbed, and when it's been a little bit, it's been a little bit more challenging to keep that space occupied, and there seems to be more absorption happening in the suburbs now, and a little reverse effect,
yeah, that's true. The only caveat that I would make to that is that we're still seeing a lot of demand for urban retail, but we're seeing demand for urban retail in the neighborhoods where people live, not so much where the places where people work. So maybe in the heart of downtown Milwaukee right now, my job's a little bit tougher when it comes to leasing because there are fewer office occupants down here. But when it comes to, and to be very specific to Milwaukee, the 3rd Ward or Bayview or the Harbor District or the East Side, North Avenue, Downer, some of those markets where people aren't going to the office every day, but like you, Jeff, they're sitting in a coffee shop right now. We're seeing demand for those markets. We haven't seen. In fact, we might be seeing an increase in demand for those markets on the leasing side. And that, I think, is translating into why we're seeing demand from investors to invest in those markets. The asset I described earlier that we're under contract for is in a neighborhood. And I think the investor looks at that and says, if people don't go back to work or if some of these trends change, I want to invest my money closer to where people are for the majority of their day. And that means getting closer to rooftops. Main Street, USA, Milwaukee, other than the 3rd Ward, and Downer to an extent, doesn't really have a high street, but people are looking in those markets, I think, more so than potentially, in our market, Blue Mountain Road or Highway 100 or 76th Street, some of those, markets that really require a lot of daily traffic, people coming and going primarily to work. People want to invest close to households. And that's been the biggest trend that we've seen on the investment sales side for these neighborhood centers. Christian, let's talk about your single tenant net lease and some of these super low cap rates.
Sure.
Who's lending? Back to the lending discussion, who's putting out debt at these incredibly low cap rates?
Yeah, I mean, most of the deals that we're doing that are really low cap rates, I would say are cash buyers. That being said, we are seeing some, family offices and stuff like that using lending. But a lot of those are exactly kind of what Jeff said. It's a case-by-case basis. Or they just have great relationships with particular lenders. It's some sort of credit union. They have a line of credit or something like that where they can basically always draw on money. And that's, the biggest players that we're seeing on that stuff. I mean, we're selling multiple 2 to 3 tenant type deals, and both the deals that we're under contract on are using, local banks, basically. They're both in Wisconsin. So, I think that we're still seeing lending is back to normal or somewhat. It seems like the banks are hungry. They're just being a lot more selective than I guess they were, 8 months ago, which makes sense. So, kind of the same things you guys are seeing, but most of the really, really aggressive cap rate deals are people who just have money to place, or they're in a 1031 exchange and it's just an all cash offer.
Is there any reason to wait? We're almost out of time here. It's 11:14, and we're going to go a little bit long because I think this is a great discussion. So if you're an owner of real estate in any asset class, single tenant, net lease, neighborhood shopping center, power center, whatever it might be, and let's just assume for this discussion that your tenants are in good shape. They behaved well, or singularly or in combination, you have a good behaving rent roll, you have a good fundamental piece of real estate. And you've made up your mind for your own purposes that you're a seller. Maybe it's a long-term vision, maybe it's estate planning, etc. But you've determined that you're a seller, and you've determined that you're a seller in the next 12 months. Is there any reason or risk? Is there any reason why you should list now and sell now, or do you perceive any risk for delaying that decision?
I don't know. I think there's a little event going on November 3rd. That might have something. That might have, I think this is my 4th election cycle in my career, and there's always a little bit of a pause before an election, presidential election. So that certainly comes into play in discussions about the longevity of 1031 exchanges. I mean, for Christian and I, let's be real. I mean, if 1031 exchanges were to go away, that's a major disruption to the business,
definitely,
to our industry. So there's that, of course. And interest rates, obviously the Fed has come out and made some pretty, substantial statements that interest stay where they're at. So I don't think that from that standpoint, we're not going to see a lot of fluctuation in cap rates and pricing, and the spreads are still going to be pretty attractive. But certainly the election is that could be a major influencer of the market moving forward. So, but the interesting thing is, at least in my experience, after this will be the fourth one, right after the election, everything kind of goes back to business as usual. So I don't quite understand the disruption or the psychology behind the disruption in an election year. But historically, hopefully, knock on wood, after the election's over, it'll just go back to business as usual like it normally does. And buyers and sellers, because it's like anything else. What option do you have to just not be an investor anymore, to completely get out of the industry? I mean, obviously that could happen. People could just decide that this isn't where they want to, entrust their assets. But, for the most part, you figure it out, and there's going to be changes, there's going to be adaptations, but you're still going to move forward, and it's going to be one foot in front of the other like normal. So.
Yeah, I agree with Jeff. I mean, I think I would still tell sellers to bring out properties now, just because of how kind of hot the market is right now for particular assets. But I think you're right. I mean, you hit the nail on the head. The tax law changes that could go into effect, and the proposal to eliminate 1031 exchanges, I mean, that's would really crush our business. So, but that being said, does that mean people are just going to hold assets a little bit longer than they were, right? I mean, some of these people are buying assets and flipping them immediately to try to get a better price. So, maybe there's just a little bit less of that. But as if I was to tell a seller, I mean, I think, right now is a great time to bring out a deal, especially because I think the first quarter is going to be, as hot as it is right now.
So last question, because we're over our time. We'll try to keep this one brief. I think as brokers, we all start to get nervous around this time of the year. We've had hopefully a good year, challenging year, but a good year. I think we all start to get worried about next year as brokers, as it relates to volume, and that relates to some of the investors who are watching as well, who rely on those returns and those results. How do you feel about next year? What's 2021 look like for the three of us?
Basis, I don't imagine it changing too much than it is, than where things are right now, just because of how things were before the pandemic. And honestly, the last 2 years have just been, record lows. So I think things are kind of going to stay the same, in the net lease space, the single tenant.
Record lows, you mean like record low cap rates?
Yeah, yep. I mean, we just sold an off-market Home Depot deal, sub 5%. To an exchange buyer. And I don't know if we had brought that to market if it would have traded as aggressively as it did. But I mean, someone's willing to pay up for something like that. So I think that things are still going to be aggressive as they are today.
Yeah, I think that Home Depot example and some of the other examples that we have with the high credit tenants is that flight to quality. So I think we're going to see that continue as a trend for sure. Interest rates will continue to keep cap rates aggressive, I think. And, for the multi-tenant side of things, I think we're starting to see that start to take shape a little bit, and it'll be, anchored or shadow anchored deals. Grocery anchored, of course, is going to, in my opinion, going to lead the way, because that's where everybody's going to find the most stability, I think, in terms of the rent roll and just, the generation of revenue from these assets. So I think, 2021, if I had to predict, is going to be, obviously it's going to be better than 2020 if there's no other further disruptions that we're not able to see at this time. But it certainly feels like it's starting to take shape already, that there's some pent up demand. There's a lot of investors that have raised capital or have funds that they allocated for this year that they weren't able to place because the second, third quarter was so quiet. And I think fourth quarter is going to be pretty active and pretty robust, and then that's going to carry over into next year. So hopefully that's not just optimistic broker mentality, but we're seeing it. I mean, we're feeling it just on the amount of inbound calls and interest and buyer activity. So.
Yeah, I think you're right. I think we're going to see all of that. I think we're going to see some pressure from some of the funds who have raised equity, who need to deploy that equity in the fourth quarter here, looking to compete for some deals. I think that so long as the capital markets stay fluid for what I'm focused on in these neighborhood shopping centers, I think we're going to see a lot of increased competition. Jeff, you mentioned that you're not, these investors aren't going to run away from, what they know, which is retail investing. And I think what you'll see maybe is some investors, shifting, as we've discussed, the asset classes that they're focused on. So I think that's going to keep us busy. I think that sellers are going to become sellers not because their assets are inferior or diminished, but because they are, aging out. Maybe, they're 60 plus and don't want to deal with the day-to-day decisions of truly operating a decision or operating a shopping center and making those decisions. So I think that's going to create some turnover in our market. Good quality properties available for sale. And the tax law and these 1031 effects are going to have a huge bearing on things as well, which I think is going to heat up for the fourth quarter. People looking to make their moves and put themselves in a position where they want to be, depending on the results of the election. And 21, barring another pandemic or and hopefully with some sort of a solution here in the form of a vaccine or more positive outcomes, I think we're in good shape. From the sales reports that I'm hearing from tenants through our management company and through my direct interaction, we're hearing good sales reports from national, local, and franchise tenants. I think that's going to give investors confidence, and I think we're set up for a great year in 2021. This has been great, guys. I know we're over the time. It's 11:22. I'll be disappointed if in the next 12 months the three of us individually don't find some ways to do some deals together. I think it's going to be a lot of fun. I appreciate you joining for the conference today. As co-chair, I thank you.